welcome everyone to another episode of the ABCs of Smart Money Concepts. Today, we're going to be diving deep into structure one more time. Previously, I have dropped a video that was an older recording that I've done, I think like over a year ago, still very relative. And today, I want to get back into structure. And I want you guys to know, as we progress through this playlist, each episode is going to become more and more detailed. So progressively going to be advancing. So I want you guys to, if you haven't, watch the videos progressively. Okay, start from the beginning. I know a lot of you are maybe a little bit more advanced, but I highly encourage you to take all of this stuff serious so that way you can build a very, very strong foundation of smart money concepts. Okay, so guys, with that, let's dive into it. So I know last time we were diving really deep into structure, okay, and today I want to do something pretty similar. So one thing I want you guys to be aware of is structure is the candles. Okay, it's the bodies of the candles. Now, this chart that you guys see in front of you is a candle chart. Okay, each of those, I guess you can call them lines that stick out of the candle are called wicks. Right, there go the name of the candle. Okay, and everything else that you guys see here, as you switch back into the line chart, you guys can see those are all structure points. Okay, so the bodies create structure. Okay, so you notice that when we turn into a line chart and we just see purely structure, you can see that the wicks disappear. That is because the wicks are just the highs and the lows, and then the bodies are the open and closures of each candle, which I've been taught that the bodies hold most of the volume of the candles, right? So let's dive into it. Let me scoot this all over here. All right, so I want you guys to write this down. Structure consists of two phases. Okay, for now we'll focus on these two main phases. As we progress, I'll introduce other phases of structure, but for now I want you guys to focus on these two main phases, which is when we're bullish, okay, creating a high, a higher high, okay, and then from the higher high to the higher low, okay, that zone right here, that's what we call the retracement. Okay, and from the higher low over to a new higher high is what we call the expansion. Okay, so this is the two main phases of market structure. So a bullish structure consists of a series of higher highs, higher lows, higher highs, higher lows, higher highs. Okay, the reason that they're called higher highs obviously is because this high is higher than the previous high, and the reason that they're called higher lows is because, of course, this low is higher than that low, right? There go the name, higher low, right? So bullish structure consists of a series of higher highs and higher lows. Okay, so let me delete all of this right here, and we're going to reverse the chart. Okay, we're going to reverse the chart, and now we're going to have a series of, let's do this. Okay, now when we're bearish, we have a series of lower lows and lower highs. Okay, from the lower low to the lower high, is what we called the retracement of the bearish trend. From the lower high to a new lower low is what we call the expansion of a bearish trend. Okay, so in a bearish market, it consists of lower lows and lower highs. Lower highs, of course, is because this high is lower than that previous high. There go the name, lower high. And then this low right here, the reason that they're called lower lows, of course, you guys might have already picked up on it, is because this low is lower than the previous low. Okay. So a lot of individuals, when we're studying this, may get confused on things like this. When we create a lower high, then we created that retracement, and then we're expanding to the downside, and then we get some structure within that expansion to creating a new lower low, right? And so once we created that lower low, from that lower high point, we created this structure within our expansion. Okay, and it could be within the retracement or the expansion. These guys is what we identify as liquidity. Okay, so not to get confused with an actual lower high just because it's a lower high than the previous high. Okay, these guys, until a lower high creates a new lower low, okay, it can be considered liquidity. So now I'll show you guys an example. Let's say we're bullish now. Higher high, higher low, right? Or at least we think it's a higher low. And a higher low is not a higher low until it gets above the previous higher high. Okay, otherwise we can just come back down, take out that low, and create a new higher high, which happens a lot in price action. Okay, it is my belief that the market is liquidity engineered. So within structure, we will have a series of higher highs and lows within our expansion or retracement. So now this is our higher low right here. So between the higher high to the way of the higher low, we created some what we call liquidity. Okay, we created some intermediate highs and lows that can be considered liquidity. Okay, so following structure is very key to understanding when you're inside a liquidity and when you're in structure and expansion or retracement. Okay, so now from that higher low to a new higher high. Now, not until this higher low, until that low creates, okay, I want to be clear on this, until that low creates a higher high, it's just a low. It's just a previous low. Okay? Once it creates that higher high, then it becomes a higher low. Right? So, we're going to have a bearish example. As we're coming down, creating a lower low, we're going to have almost a new lower low. Okay, and so this high, this previous high here, has yet to create a new low. And until it creates a new low, what price action can do, as long as it's respecting that previous lower high, what price action can do is come back, sweep that previous high, and then continue to the downside. Okay, and so you see this is just a high. Okay, liquidity, that's disguised as a high. And this right here becomes our new lower high that actually expanded to the downside and achieved a new lower low in structure. Okay. So again, I want you guys to really study this part because it is very crucial in structure, to understand structure, the difference between structure and liquidity. Now, structure will consist of series of highs and lows, okay? But validating structure consists of new highs and new lows, right? When you're bearish, it consists of new lower lows with the respect of the previous validated lower high. Okay, just because in a bearish structure we have, okay, just because in a bearish structure we have swept previous highs, the only thing that would make that a now bullish structure, or the only reason I would consider that as a bullish structure is if that was a valid previous lower high. Okay, so with that, we're going to introduce breaks of structure. Okay, so keep this all in mind. Write down notes, revisit rewatch this video as many times as you need, because this is super crucial to understanding structure. Okay, so now, when you're seeing a bearish trend, and you see lower lows, lower highs, lower lows, and price action starts to break valid lower highs. Okay, so now we broke that valid lower high, as you can see. So we have lower high, lower low, lower high, lower low, and then we retrace to another lower high. Notice that each previous lower high is being respected by the new lower high, and each previous lower low is being rated and traded through by the new lower low. And these expansions and retracements can be small or can be very large. Okay, as you can see here, we have a lower low, and then we have a lower high, and then boom, structure does what? We break to the upside. And so this is no longer a lower high, but once a lower high is broken or disrespected by structure, by the bodies of the candles, we have what we call a break in structure and a new higher high. So then we can anticipate what? A retracement to a higher low, right? So now we have higher low to a new higher high, right? We create some lows, then boom, higher high, and we break to the bullish side. Okay, so this is important. I want you guys to study this, review this as many times as you need to. What my goal is, guys, is to make trading as simple as possible. Okay, simplify these concepts as much as possible. So to do that, I'm going to be creating very short videos, easy to digest. I want you guys to understand these concepts need to be easy to digest. Do not move forward until they make sense. Okay, so to wrap it up, we're going to validate our bullish structure. So every previous high should be traded through with a new higher high, and every previous higher low should be validated only when we create a new higher high. Likewise with the bearish, every lower high should only be validated once it creates and expands to a new lower low, right? And then every lower low will retrace and create a lower high. Okay, but validating that lower high is crucial to understanding where you're at in structure. Okay, validating those higher lows with a new higher high is crucial to understanding where you're at in structure and making sure that you're not a part of the liquidity. Because again, my belief is that the market is liquidity engineered. So with that, guys, we're going to be wrapping up this video. I will see you guys on the next video. Please comment down below any questions, comments, observations that you made throughout this, throughout not just this call, but throughout the whole series. And let me know what other forms of concepts you guys would like me to review. Give me any type of feedback, constructive. I accept it all, okay? So with that, guys, much love, trade responsibly, and clap easy. Peace.